Hi, everybody. It's Jeff Barton, and welcome to the Mortgage Minute. We're on several times during the week, sometimes more than that. Facebook, LinkedIn, a number of our other social medias. We're also on a radio show that's in about 5 states, and certainly on YouTube, Jeff Barton, the Mortgage Voice. Go there, see what I'm talking about on a weekly basis, what moves markets, and how best we can serve you by bringing you some products from accounts and banks that lend money. Anyway, let's get right to it. The housing market, right off the top of the bat, I want to say hey to John. Appreciate the information about his thoughts on the housing market and possible crash. There's a big difference between 2008 and today. The main reason I think that is because the front end of all these loans are pretty well done since CFPB and Dodd-Frank and all those restrictions on what used to be called, what were they called? They were called bad loans, I guess is what they were called. But today, that's quite a bit different. And the front-end ability to repay, FICO score, that's all changed the nature of how we look at loans and how we get loans approved. But who knows? I mean, stranger things have happened in terms of housing markets. The mortgage rate's 4.28 for the 30-year, 15 years at 3.53, 3.75 for FHA, 3.75 for jumbo, and 3.68 for the 5/1 ARM. The 10-year is at 2.0009, and the 2-year is at 1.75. I like to now bring both of those into play because they always talk about the yield curve inverted, and usually that means that the 2 years making more than the 10-year. Well, you can see here it's a quarter point difference or more, and probably will remain that way. Why things cost the way they cost? Inflation is really probably the biggest thing on consumers here in the U.S. Around the world, it may be different, but here in the U.S., especially with the inflation number at 7.9%, I thought it'd be interesting just to think a little bit and talk a little bit about what's going on in terms of why things cost the way they cost. I have 7 or 8 things that I think is the reason, and I'm going to lay them out here now. Corporate margins in public companies. Okay, so if in fact a thing costs more today than it did yesterday, why is that? One of the things for corporations who are public corporations is that they maintain the value of their corporations by what's their stock price is. In order to keep their stock price what it is, the margins in what they make for the products and services that they produce must remain a certain way on their quarterly reports in order to keep investors satisfied. So there's a disincentive for them to lower prices or keep prices lower in order to stop inflation. So naturally, they're just going to continue to raise prices in order to maintain the margin so that their stock price doesn't go down. And by the way, their stock price really is how they borrow money. If your company is worth $1 billion today and some reason your stock falls and it's only worth $750 million. Well, guess what? You can only use that $750 million number as the collateral for your loan. Just ask Donald Trump and his problems with his real estate holdings in New York. Number 2, the government budgeting. Okay, the cost overruns on approved spending. Problem with government budgeting is that they budget some 2 to 5 years in advance. They'll approve a project and then figure out how to pay for it based on that. But if cost overruns happen, if costs go up, government just pays. It's part of the incentive-induced relationship they have with both projects, their elected officials, and the companies that they do business with. Most government projects are cost overrun by 20%, and that's quite a big number. Number 3, companies raising prices when they don't have to. A lot of this is what we call gouging in the marketplace. We hear a lot of politicians screaming about companies charging too much money when they really shouldn't be charging that much money. I think that happens. I don't think it happens as much as people think. I think the market really pushes people into doing what they do in order to maintain what they have so that they can continue business as it is. Now, in times like this, when inflation is running so high, it's possible that we should be able to reverse that thinking. In Nixon's day, what he did was freeze prices and wages. Now, we're nowhere near that and probably couldn't stand it politically, but that was the solution at that time. Number 4, Fed's cost of borrowing. Okay, the chess game that they play, i.e., should we raise today? Should we stop the stimulus? This is like a chess game that we see the Fed playing, and they're 9 board of governors trying to figure it out. Really, we need clarity. We need consistent clarity from the Fed as to what is going on, rather than an apology that they missed the boat 3-4 months ago when they should have raised interest rates and should have stopped the stimulus. Number 5, workers' freedom in the labor market and forces to put them back in place. Okay, this is an important aspect to daily lives of people. If in fact we had wage hikes of 10% and inflation was 8%, well, workers would still be able to say, hey, I'm doing better than I was last time. But there is a great drive to continue to keep workers underpaid in many industries. And because of that, the pressure to raise prices cause inflationary pain, thus driving people back to lower wage jobs, is real. And it happens in many, many industries. I don't think it's a concerted effort by some cabal, but I do think that companies would rather pay less than more. Wouldn't you? Number 6 or 7, whatever this is, the Ukraine and Russia issue. Yes, it is a problem. It is not only a problem because we're looking at what exactly drives prices because of a war and the products they actually need during that war, whether it's food for the people on the ground or bombs for the people who are fighting it. It distracts from what the real issues are in most people's lives. In the U.S., yes, this is a dominant news story, but the real story is, hey, we're paying way more than we used to pay. And $100 at the gas pump the other day for a car that really only has 15 gallons in it, that's a big number. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening to me. We'll rattle on here. Bye.